What is the real key to creating wealth? That is the question we're going to be talking today about.
You are listening to Wealth Talks with the McPhees. I still remember Nelson Nash during his seminars. The line would come up, Fortune Magazine, 1993, and I knew what was coming. It was a concept called economic value added.
And the article was entitled The Real Key to Creating Wealth by Shawn Tully. And in that article, he talked about the cost of using capital. And he was specifically talking to corporations who had been using other people's capital and were considering the cost that it was to the company to use that money. But when they used their own capital, it wasn't being considered in their profit statements.
Yeah, so when they had to borrow money from other people, whether they borrowed it from the banks and paid interest, or whether they issued bonds and paid interest to the bondholders, they were paying interest. But when they used their own cash, didn't that have a cost?
And that is what Shawn Tully brought out in that article way back in 1993. And it changed the way the corporate world looked at creating wealth. And that same principle applies to your own personal finances. And that's what Nelson Nash always mentioned in his seminars and talked about in his book, Becoming Your Own Banker, because that was the key to what he said was the difference between what everybody else was doing and what you could do to create wealth.
And why is that? Why does that help you to be more profitable if you recognize the use of your own money has a cost?
Well, I remember Nelson asking me the question, Tom, is your money worth as much as everybody else's? And I said, well, yeah, at least I think it might even be worth more because when I spend it, I have to go back and work for it again. And he said, then why aren't you paying yourself what you pay other people when you use their money? And when we take that into consideration, we start recovering the cost of interest. And interest is paid by everybody who purchases anything. They either pay interest to somebody else when they use their money, or they lose the interest on their own money when they pay cash for it.
That's a good point.
And
so this is a way of thinking about the costs of your own money. So when you have cash just sitting around, it's not a 0% interest rate when you go to spend that money. You need to attach some cost to that.
There is a cost to it because you forfeit the interest you could have earned on it. And people will say, well, you don't earn anything on money today that you're keeping. Well, it depends on where you're keeping it.
That's a good point.
There are places where you can keep money and make a significant difference in what you're doing. But the truth of the matter is, even if you could just earn 1%, and this is what Nelson used to tell me, if you could just add 1% to what you're making on the money you're keeping right now, would it be worth it?
Yeah, even money in a savings account.
Sure.
People would be jumping up and down to get an extra 1%.
Yes. And that's what EVA was all about. And it made a huge difference in corporations way back in 1993. And if we would apply those same principles to our own personal finances, it would make a huge difference in our wealth creation too. And that's what the infinite banking concept was all about.
And yeah, most people don't think in terms of interest. They think in terms of money in, money out, cash flow. And although that's an important consideration, why is it important to think in percent or in interest?
Well, I think it goes back again to something Nelson always said. Everybody knows the price of everything today, but the cost of nothing. And so we have been programmed to say, well, I can afford this monthly payment, but we don't understand that monthly payment over a period of years or months or whatever we decide to extend that credit out to, creates what's called a volume of interest that can be crushing.
Okay.
For example, in 2019, Americans paid $122 billion with a B on credit card interest alone, which is up 50% from what it was 5 years prior to 2019.
Wow.
$122 billion. Just think of if that money could have been kept in the sector that's paying it out to the credit cards.
It would change the economic composition for sure.
It certainly would. And so we have to be aware of that. And that is what we do here at Life Benefits, is try to help people understand that you have to have a place where you can control money and still get a return on your money when you need to use it for something else. Mr. Nash called this the perpetual tailwind. Mm-hmm. And as a pilot, we understand that if we're traveling to, say, San Diego, and we got a headwind that's going 120 miles an hour, and our plane only goes 100, we better not get up in the air because we're going to end up in Santa Fe, not San Diego.
Sure.
However, if we have a tailwind of just 20 miles an hour going to San Diego, we're going to get to San Diego much faster in our little airplane because now we're going to be covering the ground at 120 miles an hour instead of just 100.
Good point.
And that perpetual tailwind is what Nelson realized was found in only one place out there, and that is participating whole life insurance. Now, the fact is, it's guaranteed to get better every year.
Mm-hmm. And that's an important point because, a lot of places promise to grow your money, but how many of them are actually guaranteed to grow that money every single year?
Well, according to the study we did when we were preparing for our investment license and registration, there's only 3 places that guarantee that your money will be safe with them. And that's banks that are backed up by the FDIC, bank accounts.
Yeah, up to 250,000, I think the limit is for most people.
It is. Mm-hmm. And then U.S. Treasuries, and they're backed by the federal government.
Sure.
So
now, of course, the market value of those treasuries can fluctuate. So as long as you know you're going to hold it the full term, that's where the guarantees kick in there.
That's right, because even with a bank account or the treasuries, if you get your money, mm-hmm. you're going to lose the interest on it. True. Or you're going to pay the penalty on the bonds with the U.S. treasuries.
Yeah, or based on whatever the bond market's doing.
Yeah. So, and the third place is certain life insurance contracts, like guaranteed annuities mm-hmm. or guaranteed whole life insurance products.
And that's different than even the U.S. treasuries because now you're not subject to the market if you need to access that liquidity. In between the time, you don't have to sell the bond in a different market.
That's correct. But even with an annuity, you could pay a penalty if you had to access the money early.
That's true.
And so the only place that we have this flexibility, this control, is in participating whole life insurance, where we have a guarantee that we're going to earn a certain percentage and the possibility of earning dividends based on the profits of the company. And we get to use our cash value or our paid-up insurance as collateral, and the insurance company will let us use their money and not penalize us and deter the growth on our own money.
Yeah, and that's really nice because one of the things that people look at, when it comes to life insurance is they say, well, what is the rate of return on it? And because the insurance company is guaranteeing the values in the contract, there's not necessarily a fixed percentage every year that's going to go up, but we do know that it's going to get more efficient every year, and there is going to be an increase in the dollar value of that cash value every single year when the policy is designed correctly.
Yes, and unlike other policies that are only renting or leasing insurance from year to year, mm-hmm. in a whole life policy, you're actually guaranteed that you will own the life insurance. So it's like buying a house or buying a car. Every payment you make, you own a little bit more of the death benefit. Mm-hmm. And eventually, in a life insurance policy, the guarantee is you will own 100% of the death benefit. And if you surrender the policy, they will have to give you back all the money that you paid and more for that death benefit because you own it. They're only managing it for you. Mm-hmm. And so that gives us that tailwind that Nelson was talking about as a pilot. And that was what was missing in corporations before Shawn Tully came along and said, hey, look, guys, you're missing out on a huge, huge part of the pie here.
With economic value added.
Economic value added, otherwise called EVA.
Yes. So what is it that we have to do, like a numerical example of this here What do we have to do to exploit the time value, the time factor in different compounding situations?
Well, this is where I've always said that you don't need life insurance to do what we say. And, I remember when we created the IBC app for the Apple iPhone, and in that we used money from 401k, we used our cash, we used money, I believe, from bonds, wasn't it? And also from a life insurance policy.
Yeah, something like that.
And we figured out the cost associated with that in borrowing money from each of those entities. And it was very fascinating that life insurance always came out on top, proving Nelson Nash's concept that whole life insurance, is the best place to store your money that you're going to be leveraging. Now, let's say that you have $10,000 and you're going to borrow it over a 4-year period of time.
Okay.
So I'm going to come to the bank and I'm going to say, I need a loan. And they're going to say, how long do you need it for? And I'm going to say, I need it for 4 years. And they're going to give me an interest rate. Let's say that they say, we're going to charge you 5% annually compounding.
Okay.
Well, that means at the end of 4 years, I'll have paid back the $10,000 to the bank plus $1,280.47 in interest.
Is that making monthly payments?
That's making monthly payments. Okay. Now, if I had $10,000 of my own money that was earning 4% in a savings account, or maybe even a 401k, or in a bond, or wherever it might be.
So this is where the before economic value corporations would have just said, well, I could spend my own cash and not have to pay 5%.
That's right. And that's the way so many people think that, let's get our house paid off so we don't owe someone else interest. Well, now all your money is sitting at the mortgage bank.
Yeah.
And it's not earning a dime for you. And all you're getting is what the market value of your house does from then on out. Okay. So
what do we do instead?
So my $10,000 I decide to spend instead of continuing to earn the 4% that I was earning on it.
So you were earning interest on this.
So I either borrow it or withdraw it from some place I've been keeping it. And now, over those same 4 years, I lose $1,698.59.
Wait a minute. So you lose more interest than you ended up paying at 5%.
Yes.
Just because you didn't earn 4%.
That's correct. So if I would have kept earning 4% on the $10,000 I had and used someone else's money and paid them a higher interest rate at 5%, I would still have $418 in the black rather than going in the red by using my own money.
And that seems so counterintuitive. What makes the numbers work on this?
It's the fact that compounding interest is paying less each time you make a payment because you've paid part of the principal and you've paid the interest for that. And then now the next year when it compounds, it's only compounding on the principal that's left. So in a loan with compounding interest, you consecutively pay less interest each year.
So a decreasing balance.
And when you have compounding interest working for you, the only time you're going to earn that 4% is in the first period, because then that interest gets added to the principal. So you're earning more interest the next time around because you have a bigger principal balance that the compounding is taking place on.
That's perfect. So that's how we exploit the difference in the time factor there.
Yes.
And it takes time for this to happen. This isn't an overnight thing. We could, unless you're actually going to shell the money out of pocket and make this happen over a 1 day period.
Right.
You're going to have to take some time to do this because you make these payments each month out of pocket while you allow the $10,000 that you would have originally used to continue earning interest at that 4% and compounding for you.
And that's what Nelson Nash said, we have to become our own banker. Not that we set up a bank, not that we do that, but we have to think like a banker does. The banker understands that $418.12 is 4.181% of $10,000. That's the economic value that's added to the bank when they do their lending. Mm-hmm. Why don't you do that with your own money? And it didn't cost you anything to do this.
No.
All it did is cost you the time to build the base so that you have the equity to leverage. And that is what the life insurance does for us.
Very good. So where's the best place to keep that $10,000 that's going to be compounding, at the quote 4% in this example? But where do you get 4% in today's world?
Well, that's a good question, and we certainly live in different times in 1999 when Nelson wrote his book. But with dividends and with the guarantees that are provided in a whole life policy, over the lifetime of a whole life contract, it's very feasible to earn 4% or more.
Yeah,
with dividends.
Somewhere between 3 and 4 is very normal to see when you're looking at the internal rate of return.
Which, if we compare that to a taxable account, like a 401k or an IRA, that's equivalent to 2 or 3%, more, because the life insurance policy, if you follow the guidelines and the rules, will never have to pay taxes on that money again. And then when you start considering the liquidity and the ability to use that money, then now we're getting into the infinite part of the infinite banking concept. We can't define that because everybody's going to be doing it different.
Yeah.
But there's infinite amounts of ways that you could make that money grow and work.
Yeah. And that's why we use the whole life insurance, is because you can get a higher return. For a few reasons. One, because you can get a higher return right now than you could get by just keeping it in a savings account. Number two is because you're also getting protection at the same time, the life insurance protection. So you're basically getting two things for the same buck, the same outflow. And so not only do you get the guarantees for the next year or the next 2 years, you're getting it for a lifetime. And so you're locking in these the guaranteed returns on a contract, and you know that you have something that you can count on moving forward into the future.
Now, maybe this is a question you can answer, John, because someone always says, well, I could take a loan against my stock portfolio, or I could take a loan against my mutual funds. So why is whole life insurance better than doing that?
Well, those types of investments fluctuate, so you're never going to be able to get the full representation of the value that are in those accounts, because if a bank is taking those as collateral, then they have to also take into account that those assets could fluctuate. And also, with the life insurance, you have a guarantee that there's not going to be a loss in that money.
That's right.
You know that money is going to be there. And you don't have to worry about whether some bank is going to be willing to lend using stock or mutual funds as collateral in your portfolio, because when you're ready to get a loan, you can just go right to the life insurance company. It's an easy signature process.
That's absolutely right. Now, there is a warning that we need to mention here. All life insurance policies, even whole life insurance policies, are not created equally.
Yeah. So okay, you're saying we can't just go out and ask your life insurance agent in your local town for a whole life insurance policy and say that it'll be a good policy.
That's correct. And sadly, I've talked to way too many people that have decided to go with a friend that's a life insurance agent, or someone more local that they can see face to face with. But this is what happens to them so frequently, and then they come back and say, "Oh, if I only had listened to you." So let's just talk about a recent policy that came across to my desk for review. This gentleman ended up paying 21.24% more in premiums than the cash value, which was guaranteed in the policy at year 40.
That's not a great deal.
That means he doesn't even have what he put into it to use.
So you're saying when we're looking at these whole life policies, we need to make sure that we have guarantees that we're going to get back more than we paid in premium. We're going to see that in the cash values.
And we want to see that happen quickly, not 40 years down the road.
Yeah, and that didn't even happen in 40 years. So
it didn't. Yeah.
When should we expect to see that happening in a good whole life policy?
Well, in comparison with this gentleman, we ran an illustration, and we found that a policy that we designed in our office using the same initial premium payments guaranteed 30.527% more in cash value by year 40 instead of 21.242% less.
Okay.
So now he's got over a 30% gain in what he paid for this policy.
Yeah, that's pretty good by year 40.
And his death benefit is 154% greater than what he paid in premiums, whereas the other policy that we were comparing it to was only about 111% more. So not only did he get a higher death benefit in the long run, because that's what Mr. Nash says, if we design these policies for high cash value, then by the time we're going to need the death benefit will be greater than if we design it for death benefit today.
And life insurance agents do have to give up some commission to design a policy this way.
They do.
In order to design a policy for maximizing the cash value, you have to cut some of the commission that the life insurance agent gets. That's one of the expenses coming out that comes out through the insurance company to pay the agent.
Yes. So it's important that you deal with somebody that understands the cash value. Now, there is a way to get really, really high cash values in year one, but then down the road, it ends up costing you.
And why is that? I mean, how do they get those really, really high cash values?
Well, they rent more insurance.
Term insurance.
Term insurance.
Yeah.
So they add a term rider to the policy, which in certain cases can work to the advantage of the client, but
it buys some time.
But most often it works to the advantage of the agent, because let's say that I need $100,000 to make an asset purchase, and I buy a policy with that $100,000 instead because the agent is telling, oh, you should borrow the money from your life insurance policy to buy this asset. Well, when I do that, the highest cash value I can get from that policy is maybe 88% of what I paid in premium, even with the term rider. So now I only have, not $100,000, I have $88,000, and now I can't make my asset purchase. So the best way to use the infinite banking concept there and to practice EVA to create real wealth is to go buy my asset with the $100,000. Because an asset is something that is going to generate capital for you, all right? And then the capital that's generated from that asset, start purchasing life insurance with it. So the next time I'm ready to make an asset purchase, I'll have enough capital in my policy to make that policy loan and do it. If we violate that rule, we've violated Shawn Tully's rule of how the key to creating wealth. And that's what so many that's what is happening to way too many people when they're trying to get the highest cash value in year one. The best way to get cash value build up is to use the 7 pay test that the IRS gives us and just allow that cash value to build at the highest rate the 7 pay test will allow us to over the first few years.
Without adding that term rider.
Without having to add that term rider and pay for it, because the term rider produces no cash value. It's just leased. There's no paid up insurance that comes from the term rider.
Yeah, that's a good point. So basically, you're saying we want high guaranteed cash values, but if we're going to go overboard, then that's not going to be a sustainable way to build the wealth.
That's correct. So it takes someone that understands the internal workings of the policy to make sure that you, the client, gets the best policy for your needs and not the policy that's going to create the highest commission or a higher commission for the agent selling it.
That's right. So if you have a question for us here on Wealth Talks, send that in to john@wealthtalks.com. We're going to be doing a special show in July, and this is your last chance to send in questions for that show. So go ahead and send those, john@wealthtalks.com. We're also going to be having a live event coming up in September. That's September 17th and 18th right here in Las Vegas. The registration will start at 6:30 in the evening on Friday the 17th, and we'll have a little portion of the session in the evening and then all day on Saturday the 18th. So you won't want to miss that. Mark it on your calendar, and we'll be having additional details about that for you on the show next week. So if we can help you with policy or creating real wealth in your life using the economic value added concept that Shawn Tully talked about in 1993. It's been used by corporations and a lot of people in their personal lives since then. Give us a call, 702-660-7000. We look forward to helping you. Have a wonderful week. We'll be back next week.